and I'll try to keep the process moving here. Is Ashley Stelfox here? She worked with me this summer. She's a rising U of R senior. She helped us this summer gather a lot of the statistics and slides we're going to talk about today. So I'm going to talk about raising money. We're going to start with some background, talk a little bit about the various funding sources, move on to how to improve your pitch, some things you should think about when taking on a partner, many of which Karen Adams talked about, and then a quick wrap-up. By way of background, I'm the managing partner at Virginia Capital Partners. We manage a $50 million pool of capital. I personally am originally from Charlottesville, Virginia. I was a mama's boy, so I went to the University of Virginia to undergrad school. I went to Penn to grad school, and I've been in the venture capital, private equity business essentially since 1983. My firm, there's my partners, we have invested in 30 companies over the years. We've sold 24 of those. Our current returns are running about 28%. I'm happy to talk about our fund. I don't really want to take time from our discussion today, but we are looking for new things to invest in, so we're looking for new ideas. In terms of the general venture capital landscape, let's start there before we delve into specifics. The VC business has a bit of an image problem, in my opinion. I think we are typically perceived as below even politicians and lawyers, and so there's the old joke, what's the difference between a dead venture capitalist and a dead skunk in the road? There's skid marks in front of the skunk. So continuing on that theme, just quickly, we'll make some more fun of ourselves. The 6 things venture capitalists never say. Yeah, I'm not the smartest person in the room. I'd never heard that one at a board meeting. Yeah, I've never really run a business before, so I'm not going to tell you how to run yours. Haven't heard that one. Yeah, I'm going to step off the board so you can fill the seat with someone who knows something about anything. That's a classic. Yeah, being honest, management was right after all. Yeah, sorry I was on my BlackBerry during the whole meeting. And gee, I didn't have time to review the board package, so I have nothing constructive to add. You know, there's a lot of truth in most cliches in life, and many of those cliches do have some truth, and those of you who've been at board meetings with venture capitalists know and have seen some of those cliches in action, and so the handful of us that are aware of it try to work hard to solve those cliches. So we have a bit of an image problem in the venture capital business, and just quickly on that theme, this is how VCs are typically perceived: limousines with the Jolly Rogers, vulture capitalists, yeah, loan sharks, anything toothy. Gangsters is another popular motif. Of course, bozos, and then pirates and mercenaries. So so we kicked the venture capitalists around. Let's move on to be productive here. The funding sources, there are a variety of them, and what I really want to focus on today are angel investors and venture capital investors, and spend some time talking about what each type of investor looks for in particular. I actually am an angel investor in about a half a dozen businesses. And so I have some perspective on what I think both groups are looking for. So let's get started. You've got an opportunity, and you need to raise some dough. Let's assume you've got a fantastic opportunity like a Royal Straight Flush, and you need to raise some dough. By the way, that's the only fake bill I'm using today. All the other bills were really printed by the Mint. There are 4 primary funding sources for most small business people. There's, let's work from the bottom up. There's the so-called professional investors, angel investors, friends and family, and yourself. The most important investor of all is yourself. If it's such a great deal, you will hear this from every investor: why aren't you in? And what every investor wants to know is, are you all in? If you're in, if you have a lot of skin in the game, you're going to get a lot more attention from other people. And this really doesn't mean for a 20-something entrepreneur that it's the absolute magnitude of the dollars. It's just that it's a substantial portion of your overall net worth. So for the 23-year-old versus the 40-year-old, the dollar figures are going to be vastly different. Friends and family is your next obvious source. Generally, what most professional investors like to see is that you tap your friends and family, which are the next easiest source of money, for a sufficient amount that it'll be difficult for you to have a friendly conversation around the Thanksgiving table. So assuming you've tapped that out, you can go to the outside sources of money, and let's spend some time talking about what are these investors looking for. And most investors that I know, both so-called professional investors and angels, focus a lot on the odds. They focus on managing their risk, and so if you're going to raise money, you really have to understand what are the chances that you're going to lose money, what are the chances you're going to make money, and most investors look at this from a macro perspective. While they're interested in the odds of success of your individual business, most of their inherent analytics are based upon more macro odds of success and loss, and you've got to factor this in so you understand why both angel and venture capital investors are looking for such incredibly high returns. A lot of this is driven by the odds of success and failure. So let's start on a positive note, the odds of success. Most people would judge themselves to be successful if they were able to get public. Your odds of getting public are about 1 in 28,000. And those statistics are based upon 2007's IPO market, which was a banner year. If you use 2008, I don't have enough decimal places to go out. It would be, it's just abysmal. So the odds of your dream of getting public, candidly, is a lottery ticket. What are the odds of raising venture capital? It's about 2 in 10,000. Last year, 1,200 new companies got money in the United States. So the odds of your being one of those 1,200 is, well, it's a little bit better than a lottery ticket. It's about the same as flipping heads 5 times in a row, if you want to put 2 in 10,000 in perspective. This is a statistic from the Census Bureau, and these are the odds of getting to certain revenue levels. And your odds of getting to up to $1 million in revenue is pretty good. But getting above that, you know, getting to $5 million in revenues, you got about a 4% shot of that. But getting north of $5 million, you start getting into some pretty tough odds. Getting more than 100 million is about the odds of dying from a fall in the shower or rolling craps at the crap table 4 times in a row. It's a hell of a long shot. Yet it's amazing to me how many business plans show that $100 million revenue figure, and so you know, many entrepreneurs are frustrated that investors don't believe it. Well, the odds are a long shot. So let's switch over and talk about the dark side, the odds of failure. Most investors are concerned with it. Some of the better investors, in fact, I think the best investor, Warren Buffett, is obsessed with it. The failure rate, this is done in Bradstreet data, new businesses in the United States, 75% of all new businesses go out of business in the first year. After 5 years, the rate's 90%. The data is pretty startling. If you look at the Small Business Administration data, which you know, has an inherent bias in showing that there's a higher survival rate, their 5-year failure rate drops to 3/4, to 75%. So you can pick either one, but the odds are stacked pretty heavily against you that your long-term survivability is there. So in fact, failure is everywhere for the small business operator. This is actually me on spring break before the amputation. So a lot of what feeds into investors' expected returns are these failure rates. And if you don't understand that, you're not going to understand why they need such crazy returns. We can do the math, and we don't really have time to get into it, but trust me that in order to make a 25% return over 7 years, that investment has to grow to 5x. So if you put $1 million in a company today, you want a 25% return in 7 years, that million has to be worth $5 million. That's just the way that the math happens to work. Well, if most venture capitalists are targeting a 25% return, why do they commonly say they need to get 10 times their money? It's not that they need to fuel up the Gulf Stream, by the way. We'll crunch some numbers and explain it. So an example will help here. A typical private equity venture capital portfolio looks something like this. The old rule of thumb was the outcomes in the venture capital business was trimodal. A third of the businesses that you invested in went out of business, you lost all your money. A third of the businesses, you got a simple return of your capital back, no return. You put $1 in, you get $1 back. 0 IRR. And then the remaining third were where you actually made money. And so in order to figure out the returns you've got to make on that portfolio, if you want to provide a 25% return to your investors, this theoretical $90 million portfolio has to grow to $450. 5 times your money in 7 years, 25%. Since you're managing a portfolio, you've got to deliver from 90 to 450. So here's how the math works. We can plug some numbers in here. The failure is going to go to 0. That's easy. The return of capital is going to return capital, so that 30 stays at 30. So all the return of the portfolio comes from the gains. So in order to generate 5 times to your investors, your winners have to generate 14 times their money to make up for the losers. So when you hear investors talking about 10 times their money, they're not being unnecessarily greedy. They're being perfectly rational. In fact, one would argue that 14 times your money isn't enough. 10 times isn't enough. But this third rule of thumb, I think, is out of date. The stats we've looked at lately suggest that the failure rate's up to 50%. So if the failure rate goes to 50% and you rerun the spreadsheet here, you've got to make 27 times your money on the handful that actually win for you. So it's a pretty speculative endeavor to think about investing money making 27 times your money. It's a pretty tough gambit. And so these are the odds that most professional investors, and even most angel investors, understand. This is how I've got to take the pile of capital that I've allocated to this risky investment pool and make it be big enough that people are going to be happy with my returns. Okay, so that's the thought process that goes into most private investors' heads. Let me turn just for a minute to talk a bit about the private financing markets, and we'll this is a chart that most of you have probably seen before. It talks about the different players that are in the financing a life cycle of a company. The red line is the cash flow result. As it trends down, it's a burn rate, and as it hockey sticks up, that's when a company starts to make money. In the early days of a company's life, it tends to be funded by the founders, some angel investors, and as it begins to generate some hope of revenue, venture capitalists tend to get in, and it gets funded all the way through and up into its IPO date. The letters, by the way, on the stair steps there, most private equity transactions are structured as preferred stock, and so they're called Series A, Series B, Series C. So you see the stair step function, and you can see, candidly, the more letters there are in the cap table, the more you should be concerned about whether you're ever going to get your money back. It just applies, the company's consumed a ton of capital. And this is a chart that I don't know that we see much outside of our office. This is the equivalent of a yield curve done for private company valuations. And for most people who aren't in it day to day, it's not necessarily apparent. The value of a small privately held business goes up over time, just as the yield on a bond goes up the further you get out in the maturity curve. So you earn more for taking 30-year risk than you do for taking 90-day risk. The value of a small company goes up also with time. You generate some revenue, you start getting some metrics, people can value that, you get closer to break even. But surprisingly, the value of the company really doesn't begin to kick up and get that inflection point until much later in its life cycle, and generally doesn't move a lot until there's some profits. And so the early investors in a company don't generate much in the way of markup. They don't realize much in increased value until the business begins to see some financial milestones that would bring a larger audience into the securities pool. And again, for the early investors, you have to be patient because you're not going to see much in the way of encouragement in the value of your business going up over time. Okay, so let's talk about the venture capitalists. Some things you need to understand if you're going to raise venture capital money. By the way, this is actually the Somali pirate flag, so it's somewhat ironic that I didn't know that when we picked the slide. The average VC deal is somewhere between $3 and $5 million. So if you're going to raise money from the venture capital community, you got to target a number that's in that sweet spot, and that's been in that range. You can see over several years. I'm told we have a more recent chart that just came across my desk yesterday. This number is falling. The other aspect of the venture capital business that I think is overlooked is that very few of the dollars, in fact, less than a third of the dollars go to young companies. The lion's share of the dough actually goes to companies that have revenue, that have some profitability they can see through the windshield. So you need to raise $3 to $5 million bucks. You should be beyond a startup if you're going to play the law of large numbers to raise money from a venture capitalist. And then, regrettably, the money is concentrated in a handful of states. The top 3 states, which does not include Virginia, account for something like 85% of all the dollars invested. In fact, 3 metro areas account for 50% of the dollars invested. So where you are determines a lot of where the money is, and regrettably, Virginia ranks 9th. The dollars are also skewed across a handful of industries. The IT business, which is the blue line, tends to get more than half the allocation. Healthcare, which is the gray line, gets in the neighborhood of another quarter of the portfolio. In fact, the VC business has on average, about 60% of its portfolio in information technology. And when we did a survey of all publicly traded companies, there's something like 5,000 liquid public companies. Only 15% of them are in the IT business. We don't invest in the IT business, so we think there's a bit of a mismatch here, which creates an opportunity for those who look outside of the IT industry. So if you're going to raise money from a venture capitalist, what do you need to do? Move to California. Start an IT company, raise $3 to $4 million bucks, and get beyond the startup. I mean, that raises your odds substantially. Okay, so let's talk about the angel market. Angels have a friendly persona. They're viewed as much more entrepreneur-friendly than venture capitalists, so we gave them a friendly face. The size of the angel market is surprisingly huge. According to the Center for Venture Research at the University of New Hampshire, they estimate they follow 250,000 active angel investors. They're nationwide. They're not just saltwater investors who are in the handful of deep ports in the United States. They're all over the country. They invest last year, which was a terrible year, the same amount that the venture capital industry did, $20 billion. But they invested in 50,000 companies versus 3,000 companies for the VC industry. they also invest more than half their dough in very, very young companies. And so for those who are starting a early stage company who are not in one of the deep ports of the United States, we think the angel market is the place to be, just statistically speaking. In terms of a typical angel profile, they're 57 years old, 10 years of experience, they have 10 investments, and they're reasonably well educated, master's degree or better. I mentioned that there are about 250,000 that are actually followed, 250,000 angels that are followed, but the stats are, and we believe that number is much higher and is undercounted. The most recent data that we've seen is that there are 4 million millionaires in the United States, and we believe that most of those are interested in investing. One study suggests as many as 1 million people have an investment in a company that is another company that they don't run, which would, in my opinion, be an angel investor. So the market may well be much larger than the Center for Venture Research estimates. It could be 4 times as large. Okay, so pitching your investment idea. I'll give you a few pieces of data here and try to stay on schedule. The pitch. Step up to the plate. Some ideas in pitching your investment. I try to think about what I would tell my younger brother if he were going to raise money. What are some of the lessons that I would recommend he think about? Well, first is this funnel that everybody's seen. The typical investor does 1 in 100. I think that's candidly understated. I think it may be as bad as 1 in 1,000. It's a very, very low. It's a very, very low probability that you're going to get the dough. And in order to get your frame of reference right, I think raising money is a lot like changing careers. And so to get your frame of reference right, I would say the most successful people that do it well do it with that viewpoint, that there's a lot of network involving, there's a huge amount of prep, understanding who you're going to see, and then, of course, you have to sell, sell, sell. Some of the best advice we've seen on your pitch includes the 10-20-30 rule. Take 10 slides. You should get through it in 20 minutes. And for those of us that are eyesight challenged, use 30-point fonts, please. This is from Canaan Partners in Connecticut, has a great slide deck on their website, and I'm happy to give anybody here who's interested. It's called the Entrepreneur Workbook, and they walk through what makes a great pitch. And while I won't touch on it here, it's available for download. It's about 12 slides, and it is really fantastic. And this is also from their pitch book, and I'd like to spend a little bit of time on this. The most important point that I don't think is really on here is if you can get a meeting with an investor, you get a first meeting. The goal of the first meeting, and this is probably obvious to a lot that are here, the goal of the first meeting isn't to get the money. Nobody's going to write a check after a 30 or 60-minute meeting. The goal of the first meeting is to get a second meeting. And really the goal of the first meeting is nothing more than to make sure there's a personality fit, that you're comfortable doing business together. And so when you're in the meeting, the goal should be, just remember, you're not there to close the sale, you're there to get a second meeting. I think some of the great advice from this slide is practice. We do this a lot when it comes time to sell one of our companies. We practice in front of the video camera so you can go back and see. What's your body language? Are you saying too much? Are you defensive on questions? And then we also run through a process where we have an independent third party play the role of the prospective buyer, or in this instance, the prospective investor. And frequently it should be somebody that the inquisitor is unknown to the people who were given the presentation. So if you're going to use a law firm, use partners they don't know. And make sure you've coached them to interrupt, ask questions. By the time you get in and actually make your pitch, and you're not going to get many of them, you're comfortable in that environment, you know what you're getting into. The second good piece of advice I think on this slide is timing. You're going to get an hour at best. The 20 slides are, you're unlikely to get through them all. Most private investors I know are ADD ridden. They'll interrupt. They want to know right away this question, which may not be in your slide deck. And then the last bit of good advice here is to get there early, especially if you're in San Francisco or Boston. You know, the big dig is backed up. You can't get to downtown. Your technology doesn't work. Getting there early will pay dividends to the extent you're only going to get one shot to make that pitch. Most of you have seen these spin you should avoid. Our projections are conservative. If we only get 1% of the billion-dollar market, Microsoft is too slow. If you're not familiar with these, there's tons of great lists out there of cliches in raising money, and you should get familiar with them because as soon as a prospective investor hears one of these, their brains are going to turn off. This also is from the Canaan Partners Workbook. In terms of the process, what happens next? And this is kind of a black hole to many people. What happens next is you hear no. 99% of the time you hear no. So I think in going to raise money, the most important thing is that you have a sense that you're likely to hear no. Be prepared for it and ask for advice. Get some feedback. Get some ideas of where else you can go. I think that's the most productive thing. In order to raise your odds of success, I do think follow-up is fairly important. A nice handwritten note will distinguish you from the crowd. Typically, if you get invited back for a second meeting, there'll be a lot more people in the room. They'll want to go through a more detailed understanding of your business, and that'll probably be an hour-and-a-half meeting and a lot more questions. I would suggest to you that making it from that second meeting to a term sheet, they don't put probabilities on it here, is again a long shot. In fact, we find in instances where we actually execute a term sheet or a letter of intent that we close on about 25% of them. So the odds are long the whole process, and I think it's important to keep all your options open. Nobody likes to say no, including most investors. So be aware that maybe means no. I need to get a lead investor means no. You need to get fill-in-the-blank executive means no. If they don't call you back, that means no. A lot of people just have trouble saying no, and there's something to be said for persistence. The reality is, for some reason, it is very hard for professional money managers just to be open and say no. And we find this a lot when we are raising money for our portfolio companies or selling them. It's remarkable the black holes that these opportunities fall into, and nothing ever comes out. And so, you know, understand the signs for no. Also, there are some translation problems here. I'd like to make $1 million investment means I'm thinking about it. If you don't see it in writing, it's still a thought. I love the last one. Our due diligence is quick. I need to know your kindergarten teacher's name and phone number. The have to talk it over with my partners typically means no. There are an inability to make a decision generally means no. So let's switch gears, talk a little bit about what you should think about in any partner that you're going to take on in your business. Karen touched on some of these things, so here are some things to think about. Every investor is different. Some focus on a particular industry, whether it's technology, healthcare, food services. The other people focus on being close to home. Some people want to invest overseas. So the key is finding the person who has the fit in the business that you're entering, or in fact, here's a hoot. This actually is a fun. In terms of the balkanization of the venture capital industry, adult entertainment capital has raised money to invest in some way in the adult entertainment industry. So you're probably not going to get your IT startup funded there, nor are you likely to get money from Bacchus Capital, which has the narrow focus of vineyards in California. It's actually funded by the Bronfman family, who are probably one of the few investors who could afford to do that. I think having common interests with your partner, sharing something you enjoy doing is fairly important. You're going to be spending a lot of time with these people. This is actually from my wedding. I don't think you need to be golf buddies, but I do think if one partner enjoys big game hunting and you're on the board of PETA, you're going to have some issues. Checking references. Karen alluded to this. We think this is a huge issue. The calling around and speaking through to other people who have worked with your partner, it's just critical. It's just absolutely critical. You're going to spend a lot of time, and Karen alluded to the fact that a financial partnership is a lot like a marriage. I, in fact, think it's worse than a marriage. There's no-fault divorce. Once you're hitched, there's no way to undo it. And so you're stuck with, who knows whom here. Actually, I think this is from Easter's about 1979. You'll notice the one girl has a bracelet on. So they were in their jewelry, probably Sweetbriar girls. Verify the money. I am shocked. In 25 years of doing this, 2 people have asked me for a bank reference. 2 people. And there's no way to know, other than the fact that we have a nice, pretty brochure and a website, that we have the money. And we always are inquisitive when we're about to sell a business that we see some evidence of financial wherewithal. So, and there is nothing to be ashamed to asking someone, may I talk to your bank? Can you give me a balance sheet? There are tons of fundless sponsors out there, which basically means people who are making investments that don't have any money. And if you're not, you can sink a bunch of time in with people who have beautiful offices that may not have the dough. So verifying the cash, I think, is important. In terms of checking references, making sure people play nicely with others, your lawyer can do a very simple LexisNexis check to see if your prospective partner has spent some time in court. And what we found in life is that it's somebody who ends up being in court tends to be there over and over again. If they can't solve their problems in a business-like fashion, they're in court a lot, odds are you may well end up on the receiving end of one of those punches. Watching for bad habits. This is, do they drink too much at dinner, have trouble getting up for morning meetings, have a bad temper, throw telephones. Just be aware that people don't change their stripes after you've gotten their money. Do they have the staying power? This is a tough one to figure out for professional investors. Most funds are organized where they have a 10-year life. And if you're halfway through that 10-year life, you're talking to an investor whose their latest partnership is they're 5 years into it, they're out of money. They have to give the money back. They're going to spend the next 5 years winding it down. So even if you get an investment from that firm, they're done. So they don't have the staying power. Now, if they raise a new fund, that can be good. However, there are frequently separations from an old fund and a new fund that they can't commingle them. So it's fairly important you understand, in terms of a so-called professional investor, that they have time left on their fund that you can go back to them for additional dough. Karen talked about handling disputes. I think it's a great idea to set forth who's going to decide what. And again, I don't think it has to be in relation to voting rights. I think when all else fails, it's fairly important to set up the rules of engagement for how you're going to fight if you get to a deadlock and you can't agree. We are big believers that binding arbitration is much more effective than litigation, and so that's typically our rules of engagement. So who's going to handle the investment? You're raising money from a local successful entrepreneur. He's made a fortune Late in the process, you find out his 20-something kid who's a 3-time prep school dropout is going to be his board representative. You have a fund that's going to make the investment, but all your time is spent with an associate there, or maybe a lateral hire from another partnership. So does your funding source, does your person that's accountable for your investment have the political clout to help you get where you need to be from the funding source? Are they a hip shooter? This is a lot of 24-year-old MBAs that come to board meetings. Enough said. Mullets. Mullets are fish that swim in huge groups in the ocean. Anybody who's a fisherman here knows what a mullet is. There are tons of financial mullets. These are people who swim in packs. They look for a so-called lead investor, and they tuck in right behind that lead investor, and they don't want to do any work. You can check this out reputationally. My personal opinion is, well, they're just bait fish, so enough said. The chips all in decision. This is true especially of individual investors. Be very concerned if you're taking more of an investor's net worth or fund. It can lead to maybe dysfunctional decision making. If they're all in and you find a related business that you want to get into, they may not have the dough to get into it. Alternatively, if there's a setback, your all-in investor may want to get out because they're petrified. So if your partner doesn't have a portfolio approach to their investing, I don't know that they're going to have the discipline to treat it as an investment. They're going to be too married to it. They can't afford to lose. You need an investor who can afford to lose, because there's going to come times where there'll be opportunities or setbacks, and you're going to want to make a choice that requires your investor to evaluate those chips on the table. We talked about checking references. Ask people about their failures. How you deal with somebody in a business that you wind down, I think says a lot about you personally. And most people deal with it in a professional manner. People have some runway. They know we're going to shut the business down. Hopefully there's a little something left over for the employees to go find another job. The creditor should be taken care of as well as possible. All that can be determined by reference checking. The reason it's important to any entrepreneur is if your investor has a history of running for the exits without giving people a lot of runway, that could be you. Karen alluded to this. The downside is pretty grisly. Shutting down an office, firing people. It's messy business, and the odds of failure are substantial. And if you're 23 and you don't have a lot to lose, and in many ways you don't know what you're getting into, it's one thing. If you're 40 and it's going to wipe you out, that's something totally different. And so if you fail, what does it mean to you? According to the SBA, 90% of entrepreneurs not only guarantee their bank debt, they post their house as collateral. 90%. So the odds are that 90% of that 90% are going to fail. So they're going to lose their house. I think the better choice is to manage any endeavor you're getting into, looking at it as a portfolio, so if it goes down, you don't lose your house. So if you're going to borrow money, make sure that the bank can take it without your collateral. In terms of angel investors, let me keep moving here. This is sort of the typical view of your angel investor. The importance of reference checking on angels is just as important as it is on professional investors. Finding that there is some track record there, that they're reasonable people to deal with. In fact, there are all sorts of angel investors. This is the trustafarian, as my brother calls them. These are second or third generation wealth, no day job. Probably a tough business partner for many of us. All right, let me wrap up real quickly here. So failure is everywhere, and the odds of failure are substantial. Funding is scarce and expensive. If you're going to raise venture capital money, you should be on the West Coast. Angels are more prevalent and are freshwater. They're everywhere. You should perfect your pitch and check your partner out carefully. So the odds. What are the odds? The odds are long. The odds are tough. But as Woody Allen said, 90% of life is just showing up. And so a lot of success in life is about hard work and determination and ignoring the odds. This fella who lost his legs in the Iraqi war, the odds that he would walk were pretty long. The odds that he would be in the Olympic trials as a sprinter, about zippy. This fellow got cut from the sophomore team, went on to win the state championship, and did okay at Carolina and in the NBA. This fella took a 2-year leave of absence as a conscientious objector, ruining his endorsement potential, comes back to be the greatest boxer of all time. What are the odds of landing a plane in the Hudson and hurting no one? So I think the odds are best sometimes ignored. And these odds, I think, say it all for aspiring entrepreneurs. This is the top 14 of the Forbes 400 richest Americans list. And if you look over that list, everyone on that list made their money from business, a business that they started. And with the exception of the Walmart inheritance, everybody built that business. It's all first-generation wealth. Most of the people on that list weren't on the list 20 years ago. So the reason that everyone aspires is to be on this list or a local list approaching it. And interestingly, number 1 was a college dropout. The founder of the business that created number 4 through 6 was an 8th grade graduate of the Arkansas public school system. So my last piece of advice to you is that you should ignore the odds candidly and just give it a try. Thank you.